Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries behind those dense corporate filings. And let me tell you, today's filing has enough numbers to make your head spin. But we're going to make it fun. We're diving into Ares Core Infrastructure Fund's latest quarterly report. And it is packed with intriguing details about their investments in big infrastructure projects. Stick around because we're going to decode what all these numbers really mean for the company's health and future. And if you appreciate getting straight insights from these filings, make sure you are subscribed. We also have a Discord community linked in the description below where you can join the conversation. Alright, let's jump right into the numbers. This report covers the period ending the 30th of September 2025, and it gives us a snapshot of where the fund stands financially. Looking at their assets, it is clear this fund is all about infrastructure. As of the 30th of September 2025, their investments, mostly in non-controlled and non-affiliated companies, were valued at a whopping $1.5 billion. That is a big jump from just $339 million at the end of 2024. They're clearly growing and putting a lot of capital to work. Scroll investments at fair value, non-controlled tenant, affiliated investments, cost of $1427270 and $347,531. Respectively, scroll the cost for these non-controlled investments was over $1.4 billion by September 2025, showing a massive increase in their investment activity throughout the year. This means they've been actively acquiring more infrastructure assets or companies. Now, how are they funding all this growth? Well, they've taken on significant debt. Their term loans payable jumped from about $207 million at the end of 2024 to over $428 million by September 2025. This is a substantial increase in their borrowing, which they're using to fuel their investment strategy. When we look at their income, it is a mixed bag. For the 3 months ending the 30th of September 2025, they brought in over $22 million in total income, mostly from distributions and interest. That is a huge leap from just $79 in the same period last year. However, they also had significant expenses, nearly $20.4 million in the same 3 months. Interestingly, the net investment loss for that quarter was over $4.5 million. For the first 9 months of 2025, total income was around $37 million, but net investment loss was close to $14.8 million. This indicates that while they are earning income from their investments, the costs associated with them, including interest expenses and fees, are substantial. The real story in their operations isn't just the income or losses, but the changes in the value of their investments. For the 3 months ending September 2025, they saw a net gain of over $36 million from unrealized changes in their investments. For the 9 months, this number is even more impressive, hitting over $72 million. This means the value of their infrastructure portfolio has significantly increased on paper. Let's dive into where this money is actually invested. As of September 2025, their non-controlled investments are vast. They have significant stakes in renewable energy companies like Aspen Renewables Equity Holdings, LLC, and Denali Equity Holdings, LLC. Take Aspen Renewables Equity Holdings, LLC, for example. Their investment is valued at over $473 million. Then there is Denali Equity Holdings, LLC, valued at roughly $356 million. These are significant equity stakes. Beyond direct equity, they're also investing heavily in infrastructure debt, like first lien senior secured loans. They have loans in companies like Terraform Power Operating LLC, valued at close to $1.5 million. In their controlled or affiliated investments, Mead Pipeline Co. LLC stands out, with an investment valued at over $202 million. They're clearly diversifying their infrastructure bets across different types of assets and companies. Now, to manage risk, especially with all that debt they've taken on, they're using interest rate swaps. As of September 2025, they had a notional amount of swaps totaling over $227 million. These swaps are designed to shield them from major interest rate hikes on their variable rate debt. While they seem to have managed this effectively, the value of these swaps has swung, showing a net depreciation of over $2.2 million as of September 2025. When we look at how they value these complex investments, most of their portfolio falls into level 3. This means the valuations rely on unobservable inputs like discounted cash flow models. For instance, their common equity investments, valued at nearly $1.2 billion, are all in level 3. This highlights the subjective nature of valuing these infrastructure assets, and it is something investors should keep a close eye on. The total value of their level 3 investments was over $1.5 billion. This indicates a heavy reliance on internal valuations rather than readily available market prices, which naturally introduces a higher degree of uncertainty. Moving to the management's perspective, They're optimistic, citing strong trends in clean energy and digital infrastructure. They acknowledge the economic uncertainties like inflation and potential recessions, but seem confident in their strategy. Their total income for the third quarter of 2025 was around $22 million, a massive increase compared to the $79 from the same quarter in 2024. This growth is driven by their expanding portfolio. Even with this income surge, they posted a net investment loss of over $4.5 million in the third quarter of 2025. This again points to the high costs of their operations and financing. The real highlight from their operations is the net gain of over $36 million from investments and derivatives in that same quarter. This gain, primarily from unrealized appreciation of their infrastructure assets, significantly outweighs the investment loss. The fund is actively raising capital. Throughout 2025, they've seen significant share issuances, bringing in substantial amounts of cash from investors eager to get into infrastructure. For the 9 months ending September 2025, they raised over $1.29 billion just from share sales. Their net asset value per S-share for their class, iShares, has been generally stable, hovering around $24 to $25. As of September 2025, it was about $24.91. This stability in NAV, despite the significant growth in assets and liabilities, suggests a well-managed current portfolio valuation. Looking ahead, they continue to expand their credit facilities. A significant development is the Pioneer Credit Agreement, inked in October 2025, which includes a massive $542 million delayed draw term loan. This shows their ongoing strategy to leverage debt financing for further investment. Now, for my take on all this, Ares Core Infrastructure Fund is clearly in a high growth phase, aggressively deploying capital into the infrastructure sector, which is a solid long-term bet. They've doubled down on equity and debt in infrastructure, from renewable energy to pipelines. The surge in their investment portfolio's value reflected in unrealized gains is very positive. However, this growth comes with considerable debt, and a substantial portion of their assets are valued using models rather than market prices. This level 3 valuation means their reported gains could be more volatile than if they held publicly traded stocks. The significant increase in interest expenses while managed through swaps is also a critical area to watch, especially if interest rates remain elevated. Their strategy of using leverage to scale up their investments is classic for infrastructure funds aiming for higher returns. The challenge will be consistently generating enough income and capital appreciation to cover their costs and debt servicing, especially if market conditions become less favorable. For now, they appear to be executing their strategy effectively, but continued monitoring of their debt load and valuation methodologies is key. What are your thoughts on Ares Core Infrastructure Fund's latest report? Do you think their aggressive growth strategy, especially with the increasing debt levels and level 3 valuations, is sustainable? Let me know in the comments if you found this breakdown helpful. Please give this video a thumbs up and subscribe for more deep dives like this. And don't forget to join our Discord community linked in the description below to keep the conversation going. Thanks for watching, and I'll see you next time on Corporate Decoder.